Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. It's been quite a tricky start to 2021, as has been suggested by the title of the presentation, and we'll run you through some of the details of how that may have modified the outlook for growth in 2021 and what that might mean as well for fiscal and monetary policy heading through the remainder of this year. But we'll look in detail at what the new lockdowns mean in terms of economic activity and where the log jams might take place. We'll look at what that means in terms of how delayed the recovery might be and what sectors might be more affected than others. We'll look at the fiscal plans for governments. We have seen a number of announcements in the latter stages of 2020 and in the early part of 2021 that suggest that there is potentially more fiscal support to come. Before turning our attention briefly to Brexit and then on to some FX forecasts. So if we move on to the first slide about the lockdowns and what that's meant. Well, first and foremost, what we've seen is that the manufacturing sector actually has held up pretty well in the face of new restrictions and new lockdowns, but it's services, and probably expected to be services, that have borne the brunt of the tightening of restrictions. So we saw the European services sector drop the most sharply. They introduced more widespread restrictions and lockdowns ahead of the United Kingdom. So the UK has also seen its services activity drop, and both of them are below 50. Whereas for the US, we're yet to see any full lockdown as far as the US is concerned, but we have seen a tightening of restrictions. And if you look at things like the Small Business Optimism Index for December, that has shown that there's been quite a serious retrenchment in activity for small businesses, and you'd expect over the coming months that will be reflected by slower activity, and that ought to be picked up by the services and manufacturing PMIs. So this could prompt some delay in economic activity and economic activity returning to its recovery path, which was expected in the early part of 2021, especially given all of the optimism about vaccine rollouts alongside prior to sort of the last sort of 6 to 8 weeks of 2020, signals that there was optimism to be had over the controls that had been brought in over the spread of the virus, but clearly the new variant has dealt a blow to that, and that means that we could see some delay to those economic recoveries in the UK, Europe, and belatedly in the US. I think the US's restrictions might come into force weeks after those of the UK and Europe's. Consequently, we could see economic activity slow in the US later, but therefore recover later as well. So if we move on to the next slide, and that looks at consumer confidence measures. So I mentioned about in the US small business optimism, but consumer confidence has also been dealt a blow recently as well. So we were starting to see a recovery in consumer confidence, and then it dipped back for the UK, for Germany, for France, and also for the US. And there are some suggestions that this will hamper consumer demand recovery alongside the problems that we continue to see manifest themselves in labour markets. And I thought it was interesting that we saw Andrew Bailey, the governor of the Bank of England, talking about what the reality of the labour market is versus what the figures are suggesting. So he said that unemployment is probably running at closer to 6.5% rather than the 4.9% that's currently being recorded. So a significant difference between the current figures and what they're showing versus what the central banks think is really going on within economies. So the recent developments in terms of the more virulent COVID outbreak will have delayed the recovery, and we need to reach a critical mass in terms of vaccination programs before we can see restrictions being lifted. So you need to actually look for some signs that the pressure on healthcare services is being alleviated, but also you need to see some signs that the virus is finding it more difficult to spread because of vaccinations. So you're talking probably months, if not quarters, before you get a full lifting of restrictions, and those restrictions will be lifted in stages. So expect that whether it's in the UK, Europe, or the US, that you won't see this return to normality until at least summer, if not autumn of this year. And that depends on the rollout programs being accelerated. So mass vaccinations need to be being delivered, and at the moment that requires a significant step up in the speed of delivering those vaccinations. And it's in consumer spending that we think the biggest impact continues to be felt. So in the third quarter, we did see a recovery in consumer spending, but it was clearly hampered by some of the developments we were seeing with regard to rising outbreak levels. And consequently, consumer spending was still well below where it was pre-pandemic. And that manifested itself in terms of a much higher than expected savings ratio. So the savings ratio, which hit a record high in the second quarter, in the third quarter, it was still very elevated at just under 17%, having been at 27.4% in the second quarter. So that compares and contrasts with an average somewhere in the sort of mid-single digits, which is what's normal for levels of saving as a percentage of income. Now, I think the other thing in terms of delaying recovery is it will prove that these lockdowns will prove disproportionate in certain sectors. So travel, hospitality, and non-food retail are likely to suffer more than things that are non-discretionary. So you can expect that the supermarkets will still continue to perform strongly, and areas around home improvement, I think, will also continue to perform well, just because we're spending so much more time at home than we were expecting to do so. And particularly with travel, again, because the speed of vaccination programs is going to prove different in different countries, that might mean that the lifting of restrictions for travel will be scattergun approach, or sporadic at least, such that you don't import new strains of the virus into your domestic economy from overseas. So that could also delay recovery. And the one other thing that's specific to the UK, of course, we'll see whether or not the new rules around trade introduced in the post-transition trade agreement between the UK and EU have any material impacts in terms of logistical issues and delays at port, which could have a negative effect for both the UK and Europe if they struggle to deal with that. And so that means that there will potentially be room for more fiscal support. So the next slide looks at where the UK is in terms of its fiscal program, but this is you can read this across for other economies as well. You know, the German government is announced a recent doubling of their borrowing expectations for 2021 versus where they'd been only sort of 6-8 weeks prior to that. The Chancellor Rishi Sunak in the UK announced an additional programme of just under £5 billion worth of support measures for the likes of the self-employed and businesses. So from the from the perspective of additional fiscal support in the UK and Europe, there is room for more spending to be implemented. But of course, the hope is that we will see a significant recovery, predominantly in the second half of 2021, which means that the additional support measures will be in place only for an additional few months versus expectations towards the back end of this year. In the US, on the 28th of December of last year, they finally agreed to a $900 billion fiscal relief package. That said, given that there's been changes to the political landscape in the US recently, particularly with the Georgia Senate runoff elections, which led to the Democrats effectively taking control of the Senate, that could give the Democrats more room for maneuver in terms of implementing additional spending and fiscal stimulus in the months to come. It will depend on, again, how the coronavirus problem manifests itself across the United States. But there is room to expand the support checks that were $600 per person up to something in the region of $2,000 per person, which has been discussed amongst senior Democrats in the House and Senate. Globally, however, I think there is limited room for additional fiscal support. And really, globally, the threat of renewed outbreaks could lead to a significant delay in recovery for emerging markets in particular. Now, once the vaccination programs across the developed world are well underway, one would expect to see attention turn much more towards the rest of the world. But at the moment, the speed of vaccine development is simply not quick enough to help vaccinate the entire world. And if you're delivering 2 doses per person, then you're looking at somewhere in the ballpark of 16 billion doses that would be required in order to vaccinate the entire world. So consequently, I think the reduced access to vaccines might be of detriment to emerging markets in particular, although a recovery in the developed world may well help a lot of their industries, particularly in commodities and raw materials, benefit from an increase in demand in the later quarters of 2021 and into 2022. So if we look at Brexit and what was agreed, these are just some key points that I've drawn out of the agreement. It's not a comprehensive list. We knew it was going to be a free trade agreement with no tariffs or quotas. There's no freedom of movement on labour, so the EU citizens wanting to locate in the UK and vice versa will have to meet the requirements, the individual requirements of the EU or UK, dependent on the transit of labour. There was a reduction in fishing quotas for the EU fishing in the UK waters of 25% over the coming 5.5 years. That said, after that 5.5 year period is up, there's going to be another round of negotiations on fishing quotas. So this is not a prolonged agreement that is in place. It's actually a transitional arrangement in itself. Over fishing quotas, because the bigger issue is likely to come in 5.5 years' time, or slightly before then, when they start discussing matters over fishing and such like. There's mutual recognitions of standards, but there is divergence that's going to be allowed over things like employment and environmental standards, albeit that if either party moves away from the other one too fast, then the other party is given the right to apply tariffs in order to redress the balance. Financial services firms are believed to be allowed to operate in the EU via a system of equivalence, although that is still to be agreed. And that system of equivalence can be withdrawn very quickly. So even if it is agreed, then it can be withdrawn with as little as 30-day notice. And there's no common tax arrangements, and this has manifested itself with some of the clients that we're speaking to with regard to the application of things like VAT which was done at source previously and now is done on delivery of goods. So that is creating problems within the logistics and distribution system, particularly on a business to customer, from a business to customer perspective. The markets didn't really react to this, and the reason they didn't react is because ultimately this was what they expected to come out of the agreement. And I think that at the same time as the news on Brexit was improving, the news on COVID was worsening, and so the two things basically traded off against each other. It is noticeable that we have seen some strength in sterling over the past 24 hours or so, but that's more down to the UK Bank of England, and particularly the governor of the Bank of England, ruling out the prospect of a short-term move to negative interest rates. Even with all of the additional negativity that we've seen on coronavirus in recent weeks and days, there are some signs of logistical problems emerging, and we will have to see how those manifest or build as we return to greater normality as far as the amount of traffic that passes through the ports of the United Kingdom from the EU and vice versa. But the biggest thing that the trade deal did was it removed the risk of a more negative effect on both the UK and the EU economies from a no deal. And so there hasn't been the sort of market reaction that perhaps some were anticipating, but the reason for that is that ultimately the markets were anticipating the deal to a large extent. They got exactly what they were expecting. This next slide shows the major currency pairs. We've got some support as far as some upside for sterling dollar, but I think that's driven more by the fact that the US government now has more room for maneuver on fiscal policy, so they could introduce more aggressive spending plans than they would have been able to do had the Senate still been ruled by the Republicans. I think that sterling will potentially benefit in the short term as well from the fact that it seems to have got a lead. The UK seems to have a lead versus Europe in terms of its vaccination program, and so that could lead to some constructive behaviour in sterling euro. But you'd expect Europe to be able to spin up their mass vaccination program relatively quickly. So we're only talking about potential delays of a month or two versus their recovery, rather than quarters or even years. And I think the other sort of major thing that we note is that we're still seeing ongoing strength in commodity markets, and we're still seeing strength in commodity currencies. That will be either delta blow or will be sustained by the upturn, the upswing in global economic activity. So really into the sort of second quarter and beyond, the performance of commodity currencies like the Australian dollar, the South African rand, the New Zealand dollar, the Canadian dollar, etc., all of those are likely to either benefit or suffer dependent on the performance of the global economy versus expectations. And there is the risk that the global economy doesn't pick up quite as quick as the markets are anticipating. So you might see some setback in commodity currencies before they move higher once again. Make mention of the Chinese renminbi's performance. We've continued to see it strengthen. I think that it is unrealistic to expect it to strengthen much more than where it currently is, because it is starting to move out of kilter, or it has already moved out of kilter with a lot of other Asian currencies, and that would put Chinese firms, albeit only marginally, at a disadvantage to their counterparts in other economies. So we think that the Chinese renminbi will remain broadly stable. There have been also some conciliatory approaches made by the Chinese government to Joe Biden and vice versa. So when the president-elect actually takes office, then we may well see some improvement as far as relations, both diplomatic and trade relations, are concerned between the US and China, which which will sustain the Chinese renminbi against the dollar at current levels, or maybe even strengthen the Chinese renminbi slightly from its current levels. So that's really it. That's the outlook for the year ahead in currencies and economic terms. So one thing, just to reiterate, the disclaimer saying that we're not offering you advice. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.